ahead and get started. Again, my name is Kris Lowes. I also have Jason Stroiman on the line with me as well. We're excited to do this webinar today and just kind of share our thoughts on the market in today's skilled nursing world. Obviously, we're going through some pretty turbulent times where things are almost changing daily, it seems like, and kind of excited to share our opinions on it and share, you know, what we think that owners and operators like yourselves that are on the line today, you know, their best courses of options are, and just share some data that we have as well. With that being said, the structure of our conversation today, we're just going to do a quick introduction to ESI. I think a lot of you know us pretty well at this point. Jason will be sharing some of the basically tailwinds or things that are driving the market forward, and then I'll be walking through some of the headwinds that are out there, or you know, topics that you know have potential to have some negative consequences to valuations and to just the market in general. We'll also be inviting you all to ask any questions you have throughout the conversation. There should be a question or a chat box in your module there via GoToWebinar. So if you have a question that comes up, you hear something that we might have mentioned that you want some more information on, or want to circle back to a certain topic, feel free to just put that conversation piece or a question in there, and we will certainly address it after the call today. We'll be recording this conversation as well, so if you want to share it with your teammates or share it with anybody else in your organization, we'll be sending out an audio recording of it as well, so you can do that. So don't feel like you have to write everything down and you know, memorize everything we're talking about. So with that being said, let me reintroduce ESI. Like I said, I think a lot of you know who we are. You have Jason and Kris on the line today. What we do basically is we like to think of it as basically 5 different things. Mergers and acquisitions is our primary business. We sell skilled nursing buildings on behalf of owners all over the country. We've been doing that for over 10 years at this point and have sold over, I think, $4 billion of healthcare real estate. And that's primarily what we do. We also do a few other things. We do a lot of benchmarking for owners and operators across the country. We are fortunate to, because of our work, have a huge proprietary data set of skilled nursing expense metrics. So if you ever want to see how your building is operating compared to industry data or you know other like-minded facilities, we can help you do that. We also work in the capital markets and debt placement business with our JV partners, Carnegie Capital. They've been some of the best in the business for the last few years in securing and finding debt through a lot of basically unknown banks and unknown capital sources, and can run a very great process on how to secure or refinance debt for whatever it is you need in your community. And then we do a couple marketing pieces. We have a digital marketing piece that we partnership with to help companies build websites. And then also lately, especially after COVID came, we did a joint venture with LCP 360 to do virtual tours. So I think we have those at about 150 communities throughout the country. So everything we do is really just for the empowerment of skilled nursing and senior housing owners across the country, and we're completely focused on those types of communities. People often ask us, you know, what makes you different than other skilled nursing or senior housing brokers? We like to say that we're very team-oriented. So as you can see in this picture, we have an entire staff here at ESI. We all work on the same team. If you're talking to Jason, you're also talking to me and any of my analysts or any of the client relations folks at our team. So it really gives us some power to do lots of volume and to just completely offer we think is a real top-notch, basically customer service-oriented process. So as I mentioned earlier, we've been fortunate to do a lot of work since COVID started, and this slide here and these numbers really kind of show you, put some punch behind what I'm saying. So we've actually sold around $450 million of deal flow since March 1st of 2020, and that represents about 56 different buildings around the country. So As I mentioned, we've been fortunate to see kind of what this market has come to in terms of just different ways to execute business during COVID. It's certainly changed a lot since COVID started till now. And we've been fortunate that we actually have around $1.6 billion of deal flow that should hopefully close by the end of the year still. So very busy in the market. And why that's important to folks on the phone or on this presentation today is really just it allows us to give you real-time guidance on the feedback that's happening in the market and gives us a pulse on who is actively buying in today's market as well. So just some information about ESI. As I mentioned earlier, many of you are familiar with our company, but if you would like to know more about us or even like to know some references of some folks that we've worked with, we're happy to provide those at any time. So let's discuss the market for basically the rest of the year and basically into the future as well, where we think it's headed. As I mentioned earlier, we're going to just talk about some of those tailwinds or things that are pushing the market forward first. These are all sort of positive things and things that I think a lot of folks in the industry, may not get publicized a lot in the industry press, but we wanted to discuss them with you today. So I'm going to introduce Jason Stroiman at this time. Jason Stroiman is the founder and president of our company, and he's going to walk you through some of those investment themes.
Thanks, Kris. Thanks for all the attendees and spending some time with us this morning. So let me just preface this whole concept of this bull market with a couple things. I've personally been selling skilled nursing facilities across the country for over 17 years, and I've never seen a market like this. So for all of those of you on this webinar that have been in this industry for a long time, you almost have to forget about the kind of your historical thought process and logic on what's driving valuations. In a very counterintuitive way, COVID has transformed the industry. And I'll explain it to you here in the next couple slides on what's driving some of this. So as Kris alluded to, we lean heavily on data, and our core business is providing free valuations and benchmark analysis to people that own skilled nursing facilities. And shockingly, we've seen an increase from 2020 to 2021 of approximately $17,000 per price per bed in terms of evaluation. So if you think about that, just the percentage of increase that has happened over 12 months, despite this pandemic and everything else that's going on in the world, is pretty remarkable and really hard to get your head wrapped around. Especially for those of you that have been in this industry for a long time, it defines some common logic, but these deals are closing, and the data is what the data is. And one of the reasons it's driving a lot of this is equity. There are so many family offices and private equity companies that have raised hundreds of millions of dollars of funds, and they have to put this money to work. So the only way they can do that is to buy deals, and they're very bullish on the skilled nursing industry, and have essentially been willing to pay sellers the value as if these buildings are stabilized. For many of you on the phone, you realize that the average industry occupancy is right around 72% across the country, and we have buyers that are paying prices that are based on a stabilized occupancy. So a lot of our clients that have thought about selling but never pulled the trigger, and then COVID hit, they're realizing that they can hold out and sell it in a few years when the facilities recover, or they can sell it today for essentially the same price. So a lot of our clients are electing to go ahead and move forward and take advantage of the market. So those are a couple variables that's driving the market. And so this is essentially focused on equity in price. But on this next slide, this is really the number one component that's driving the acquisition market and the pricing is really the lending environment. these buyers that are paying these aggressive prices are getting 75, 80, 85% loan to value, which allows them to get really aggressive on the purchase price. And as many of you know, interest rates are still at a record low. Another data point that we like to track is HUD refinance volume. So while we typically don't use HUD as an acquisition vehicle, most buyers, if not all buyers, underwrite with the hope of going to HUD 2 to 3 to 4 years after an acquisition is completed. So the minute this HUD lending environment dries up or slows down, I foresee buyers pulling back a little bit and not getting as aggressive. So that is one data point that we keep our eye on. It's just the HUD volume. And again, the banks are willing to underwrite at a stabilized occupancy versus what the actual occupancy of these facilities are. So equity is one. There's plenty of it out there, but the big component again is there's so many lenders around the country that are extremely aggressive. I mean, we're seeing 6, 7, 8 term sheets for nearly every acquisition we're doing, and the buyers really have many choices on which lender they're going to go with. So if the last thing I just wanted to touch on is more operational focused and why in the world are these buyers paying these crazy prices, and what are they saying in their boardrooms, saying why is this deal a good deal even though it's 72% occupied, and we're going to pay the seller as if it's 92% occupied. And really it comes down to 4 or 5 components. One, these larger groups have a ton of ancillary businesses, pharmacy, rehab, GPO organizations. So they underwrite not just the cash flow of the facility, but they underwrite the margin that they're making on all their ancillary businesses. So if you think of a company that has 20 facilities, and let's say they add on 5 buildings, from an ancillary standpoint, even if those 5 buildings were break even in the future, they see that as an accretive acquisition because of the margin they're making on the ancillary businesses. And then the second component is really as all of us are seeing, there's so much more access to managed care, and there's people see long term that nursing homes, there is a place for nursing homes in this healthcare system. Reimbursements are getting changed for the positive. A lot of this COVID stimulus money has truly helped a lot of all nursing home owners. So there's a tremendous amount of cash out there. And as I alluded to on the ancillary side of the business, just pure economies of scale. We're actually closing on a deal September 1st, and the buyer just told me yesterday, just in 2 simple contracts. One was TV, and the other was copiers. They were going to save $30,000 in savings day one, just on 2 little contracts. So when you think about all of the different contracts, whether it's food, whether it's group purchasing organizations, they can underwrite all of that margin, and it helps them justify paying these types of prices. And then the last piece, which is probably the biggest one, is we all underwrite to a 5% management fee. So 5% of revenue, you're supposed to essentially pay yourself as quote unquote the manager. When you have 20 or 30 or 40 or 50 buildings, the actual cost to add a facility under your mothership is probably 1 or 2%. So you're talking hundreds of thousands of dollars that are just falling straight to the bottom line when there isn't a real cost associated with it. So when you add up all these different components, you truly can sit on the buyer side of the table and the lender side of the table and see and justify why you can pay this price. And if you have a 20 or 30 year outlook in this industry, the numbers do make sense, and that's how they're getting these deals done. So again, as Kris mentioned earlier, if you guys have any questions or want to poke holes in some of the things I discussed, feel free to go into your module under the question section and type in any sort of questions or comments.
Thanks for sharing that, Jason. And certainly, a lot of positive news out there. Valuations at very high numbers today. Obviously, it's not all good news out there, and I'll share some of those topics with the group here now. So we'll get into some of the headwinds. I think that there's some of these that are very temporary in nature, and then there's some that are long term. And it'll be interesting to chat about our opinion on some of those. So probably, the most prevalent thing going on right now is the Delta variant. So I want COVID to go away. You want COVID to go away. I think a lot of people thought COVID was going away. It just certainly does not seem to be the case. If you look at the trends in the most recent numbers that are coming out, we're certainly back at a number in terms of just cases U.S.-wide, that mirrors sort of the winter time and February numbers. So, if you kind of follow the skilled nursing piece of that, resident cases, basically we're already seeing that they're up about twice as much from the previous month, and staff cases are up by about 3x from where they were in the previous month. So it's certainly, making its way into the skilled nursing world again. What everybody is hopeful about is just that, that the residents at least are pretty heavily vaccinated. So we've seen just across the country that about 82% of residents are vaccinated currently at communities. Most facilities require them on some level. And with the news that there'll be another distribution, a third booster shot, certainly we hope that adds some protection. And, even at communities that have experienced some outbreaks in the recent months, it does seem like the vaccinations are providing that safety mechanism in terms of the infections not being as serious. What is most worrisome for the industry is just, staff vaccination. So that is still at a very low number compared to the resident basis, about 60% nationwide. And if you look at it on a state-by-state basis, some states are, as high as 80%, and then there's some, mostly in the South that are as low as 44%. So it varies widely from state to state and facility to facility. We've seen already that some states, I think Massachusetts, Vermont, and California are going to require nursing home vaccinations for staff. So certainly we hope that, that does encourage more staff members to get vaccinated. What we don't want to happen as an industry is to, and I think that probably the most discouraging piece about this already is that, there is discussion already about limiting visitations again and limiting group activities. The state of Florida already announced that they're limiting visitors. I think it was just earlier this week. Some other states are in discussions with that as well. Obviously, from a census standpoint, from an occupancy standpoint, that is the biggest barrier to recovering occupancy today is any limitations on visitors. Certainly nobody wants to go through what we went through last winter. And I think you all as operators know the detrimental health effects that has on your residents, just being in isolation and the depression that comes from that. So, really I think that the most important piece of this whole thing is going to be making sure that, facilities are open for business, open for new residents to move into, and also open for visitation. We certainly don't want to see that go backwards. And then, hand in hand with this, is staffing. So staffing is a long-term issue our industry is going to have to deal with. I think a lot of folks thought that, once the economy reopened and once we kind of got back to some sense of normal this summer, that staffing was going to get easier again. I'm here to tell you that, we're not going back from a staffing perspective to what the world looked like pre-COVID. We already have seen that just across the country, there's a massive labor shortage. We have 10.1 million job openings, and we have 9.5 million unemployed workers today. So we already have a mismatch out there. I saw some data yesterday that on average now, restaurant workers are making $15 an hour, even though it's not been regulated and made mandatory that wage per hour is in effect. Basically, that the market is paying $15 an hour for restaurant workers right now. So if you don't have anybody in your community making $15 an hour or more, expect to have to offer that very soon. And it certainly is something that I think that I know that I look at financials and employee rosters of a lot of communities around the country. It's certainly not a given that most people in a nursing home today are making $15 an hour. So that is obviously extremely worrisome from a profitability standpoint. Also, just finding good people today becomes harder and harder. So I think the last data point that we saw is 84% of skilled nursing buildings today are using agency staffing. Typically, that's 1.5 to 2 times the cost of a typical employee. So we talked to record numbers of owners this year who are washing dishes and cleaning resident rooms again. So it's certainly not a position you want to be in as an operator, just in terms of the stress, in terms of the advanced planning that comes from being short-staffed. And again, no guarantee that we're going to get back to where we were as an industry in terms of just the amount of employees and labor available that we were at pre-COVID. So I would say if you're not making plans to do some problem solving around this or able to offer higher wages, maybe time to rethink your strategy in the industry. And then probably a more recent thing that I think is going to become more permanent over time is just regulation in our industry. So unfortunately, COVID shone a very bright spotlight on the skilled nursing industry. Almost every other day, there's an article in the New York Times or Wall Street Journal about all the bad things the industry was doing, mostly from people that have never operated a skilled nursing building or stepped foot in a skilled nursing building. Again, this politicians and everybody else, they follow what's written in the press. And so, I think a lot of the politicians out there feel compelled to make changes in the industry just because of all the bad press that happened during COVID. So just recently, the Nursing Home Improvement and Accountability Act was introduced. Some kind of bigger changes to it I thought were noteworthy I wanted to share. One being that an RN has to be on staff 24 hours per day. I think the current minimum now is 8 hours per day. So certainly some added, payroll hours in that aspect. And then they called for facilities to hire a full-time infection preventive staff member. So certainly potentially a new, in terms of just staffing requirement there. And then also just another thing that the Act introduced was just that the special focus list, which has been a target from Elizabeth Warren and a lot of other politicians throughout the years, they're hoping to bring it so that no less than 5% of skilled nursing buildings have to be on that list in a given year. So instead of it being truly about, surveys and about potential, issues at communities, they want it to be a minimum of 5% that have to be on that list every year. So that would actually increase the number of buildings that are on that list today by 8 times. So certainly, again, not a welcome, intrusion into the industry to be classified as a special focus facility and to be basically have to have a mandatory amount of 5%. Just on a state-by-state basis, some other things that we're seeing out there is that several states are starting to increase sort of just the resident care hours. I know Pennsylvania has introduced some legislation. New York just passed some legislation regarding that. And other states, I think Massachusetts is one of them, are mandating a certain percentage of the revenue at the community to be spent on direct care staff. So again, most politicians believe that anything that's going wrong in the skilled nursing community can be solved by basically more staffing hours, more mandatory staffing. And it seems the way that is how things are going to go in the future. Another piece in that Nursing Home and Improvement Accountability Act was just that the government is certainly favoring and going to continue to invest in smaller facilities. There believes to be some sort of science or some sort of health policy now around the idea that, infection and infection control can be better controlled in smaller community settings. So there is a sort of movement in a lot of states to eliminate the licensure of 3 and 4 bed wards. Obviously, those are somewhat outdated in themselves. In most buildings that are on the newer side don't include those, but certainly can drastically change your census if you have some of those in your community and you're used to sort of filling those up. So those are some of the regulations out there that scares us, and certainly if you put all these things together, staffing costs, more staffing hours required, it's going to make a pretty outsized effect on the profitability at most communities. We're certainly hoping that states and the federal government step up to raise reimbursement to sort of match some of these costs, but as you know, that's not a guarantee. So those are some of just the themes we wanted to go over. I did just quickly want to mention, as I said at the top of the hour, what we do is value businesses and basically counsel owners on a day-to-day basis. And just wanted to go over a few steps on how we do that. So if you ever wanted to receive some sort of report from us or a market valuation, all that it takes for us to do is basically just if you can send your financial statements to us, we can do that through a confidential portal, and we sign CAs and NDAs so that you're doing it confidentially. It takes our team around basically 2 weeks or so, maybe a week, depending on the complexity of your community, to basically just analyze your building and do some data crunching on how it compares to the industry. And what you'll get in return for free is basically a 20-page plus market report with basically industry information, and you'll have that market valuation in there. And then we set up a time with your management team to go over the presentation, and we'll actually do just a live Q&A with your team. We'll identify very specific ways in that your team can benefit from just the market and basically some strategic conversation around just different strategies or different options you have. So just wanted to touch base. I know a lot of folks are kind of confused about, how do I get a market valuation, or, what do you guys do, with the information we send you. Basically, that's our process. And again, we do it absolutely free, and have done it for 425 nursing homes since 2019 alone. So are doing it all over the country. Any questions from anybody out there at this time? I know we just wanted to make sure we got to those with our allotted time still. Let's take a look here.
Yeah, there is one, Kris, and I'll read it to the group, and then I can answer it. The question was, do you anticipate the current market prices for skilled nursing facilities will lead to regional consolidation? Do you think the larger groups being willing to pay crazy prices push smaller operators out? I do believe that to be true. If you are truly in this business and you're looking for an exit anytime in the near future, the prices that these buyers are willing to pay, it doesn't make sense financially to stay in. And the smaller regional groups either need to get out or they need to grow for all the reasons I spoke about earlier around economies of scale and diversification amongst different states. And we typically see these smaller regional groups are not willing to pay anywhere close to the price these larger groups are willing to pay. And so I do think we're at a crossroads here where the regional groups need to get bigger, and if they're not willing to pay, to pay up, if you will, it makes more fiscal sense to sell. there's any other questions, feel free to pop them in there, or else myself or anyone on the team is available to have a one-on-one conversation around this. And as Kris alluded to here at the end, I would just encourage everyone to reach out to us. Let us do a quick analysis. That way, at least you have the data on what your businesses are worth, and whether it makes fiscal sense to hold on to it or to take advantage of these unprecedented times where buyers are willing to pay prices that I certainly haven't seen in 17 years of doing this.
Yeah, and I would also add, I think over the past year, we've all learned that this industry is becoming very volatile. There seems to be news that comes out every day that's impacting investors' decisions, different regulations that are coming out. If you ever just want our opinion on how those are going to impact your business, or you ever just honestly just want a second opinion about, strategy you're pursuing, or want our opinion about, just different, industry themes, feel free to reach out for us as well. Looks like we got another question. I just want to make sure we got to really quick. Are potential tax changes driving sales? Absolutely. We touched on that in our last webinar. Kind of wanted to leave it out of this one just because that seems to be in flux still. Obviously, the big infrastructure bill got passed was last week. Certainly, we're going to have to pay for that somehow. So most of the tax changes that are out there on the table revolve around differences in the capital gains tax structure to move it toward a tax that's more similar to income taxes, and then also just on a state, planning side, potentially changes in how, when those estate plans are marked at fair market value, step up issues, and all of that good stuff. It's certainly driving a lot of people to, just bite the bullet today, go through the sale process, pay your capital gains rates at a known rate, and then also to sort of take away some of that unknowns in the future of where taxes are going to be. But yeah, I think it's pretty, out there in terms of just the taxes are going to go up. I mean, they're certainly not going to just stay the same with all the spending that the federal government's planning in regards to the infrastructure bill. I have another question here. Is there a fee for your evaluation service or an obligation? Absolutely not. We do it for free all over the country. There's no obligation at all. I'm sure there's some folks on this call that have had us do that valuation for them multiple times. So it's something we do for some folks every year, just to get them updated on where their numbers are. So absolutely not any obligation whatsoever. And then there's a question about our sales primary buyers or institutions that lease the facilities out to companies to build scale. Yeah, basically the structure that the industry really grew off was just REITs that would lease out buildings to operators, and then those operators would run the buildings and pay rent back to a REIT or somebody else. It's certainly still obviously a popular investment structure. We're finding that most of the most active buyers today are actually owner-operators, people that are operating the building and growing the platforms themselves. Especially with the times we're in terms of just the financials of the building, it's very, very hard to figure out what a fair lease rate is to pay for a building today, just because most buildings' current performance is sort of in the negative. So it's kind of hard to figure out where a fair rent would be. So it's something that's changing over time. But a lot of the most active buyers today are folks that have operators in place and really aren't looking to just potentially find a tenant for a building. Okay, great. Well, it looks like that's all the questions. Again, thank you for tuning in today. Hopefully you guys found some valuable information on what we talked about. And as Jason said, if you ever want to discuss any of this over the phone with myself, Jason, or any members of our team, feel free to reach out to us. And we will also be sending around a recording or a copy of the webinar at some point, either today or tomorrow. So thank you for your attendance, and hope to chat with you all very soon.